Welcome to the current federal tax developments for the week of May the 7th, 2018. Current federal tax developments are brought to you by Kaplan Professional Education and by your state society of CPAs. Presenting here from Phoenix, Arizona, where we're heading to 100 plus for the next few days. I'm Ed Zollers, and we'll be talking this week about what's going on in the area of federal taxes. We'll have a bit of an update on something we discussed last week about Oklahoma's tattletale laws. We'll discuss a warning the IRS kicked out here during Small Business Week regarding ID theft in businesses. We'll talk about an organization that attempted to get tax-exempt status but was denied. We'll talk about the IRS's delay on a reporting requirement that was part of the Tax Cuts and Jobs Act. And finally, we'll look at the issue of at what point may a taxpayer have reasonably relied on an advisor's advice in taking a tax position. Well, been one of those weeks. So, we're taking a look at all these neat things happening here as we get into the later part of spring and heading towards summer. Many of you would feel if it's over 100 degrees as a high, we're probably in summer. But if you're from Phoenix, you're kind of aware that that's like, not really any big deal. So we're going. But let's go back and talk about something we talked about last week. We talked about Oklahoma Senate Bill 337. And what we discovered was after that was recorded, information came forward that the bill now has been vetoed by the governor. So that bill, even though it was going to expand disclosure, was vetoed. It was kind of interesting, and it makes a bit of sense as to why two bills were run. Now, they were run, one was in a special session, one was in a regular session. But why there were two of these tattletale bills instead of one, presumably somebody was kind of aware the governor didn't like this particular option, and the governor was going to veto it. So they voted for it. It's now vetoed. I checked just before we did this on Friday and discovered that, there's no recorded additional action yet on the Oklahoma legislature website. So it appears it may just simply die. There's not going to be an attempt to override this veto, though we'll need to keep an eye on that. The governor did sign a bill earlier that we discussed that expanded the marketplace, the reporting for vendors, and it was really aimed, it appears, primarily at marketplace vendors like Amazon, companies that have a presence in Oklahoma and then do something to bring in third parties. So that particular rule, the marketplace bill, is still there and still in place. And I should remind you that, as we discussed last week, even without this bill, if you are selling into Oklahoma, you are supposed to notify customers that they may owe Oklahoma use tax to the Oklahoma Tax Commission. However, there is no requirement that you tell the Oklahoma Tax Commission that you sold that to that customer. And as well, there does not appear to be any really major penalties on failing to do so. So I suspect a lot of companies aren't doing that in the Oklahoma area. But nevertheless, again, at least one tattletale bill kind of falls apart. So we have at least one fewer. I guess that's good news. Now let's go on and let's talk about the IRS issuing a small business ID theft warning. And this was posted on their website, News Release IR 2018-111. It was posted on May the 3rd, titled IRS Urges Small Businesses Protect IT Systems from Identity Theft. This is Small Business Week, or was Small Business Week. So there was a focus this week on small business issues. As part of that, the IRS put out various news releases during the week. We want to take a look, though, primarily at this one, because we've talked over time about all of these issues regarding tax-related ID theft and the security issues that arise from that. The IRS cited an increase in tax-related ID theft for business that has been aimed at businesses. The IRS says they saw a sharp increase in the number of fraudulent filings of Forms 1120, 1120S, and 1041, as well as Schedule K-1s. And they apply to partnerships as well as estate and trust forms that they found. So there's been fake returns being created. Now, they can be created for various purposes. They can create fake refunds for the entity where the address may very well be changed, so it goes somewhere else. They may be used to support individual returns that are fraudulent. There's various reasons why they may have done it. But what they aren't doing as much anymore, originally if they got an EIN, they used it primarily to generate false W-2s, then use the false W-2s to file income tax returns that were meant to be refund fraud returns. Now they're expanding into broader areas. That's a potential problem because, unfortunately, as most of us know, our business EINs are just out there, right? We give that employer identification number to all kinds of people, right, for reporting purposes. And that makes it fairly easy for a third party to get your EIN name address. They also appear, the IRS mentioned, they're aware of tax processing systems, how things are handled, and sometimes this may be inside jobs getting these things going on, but we're seeing an uptick in this. The IRS did provide for us a list of what might be warning signs that you might have been subject to business-related identity theft. First thing they suggested, if an extension to file a return request is rejected because there's already been a return filed with that EIN or social security number, that's a warning. That's the traditional one we're used to. You can't file because something else has been filed. An e-filed return is rejected because of a duplicate EIN or social security number. Again, same difference. In essence, you figure it out because the e-file system bounces it back at you. You receive a Form 5263C or a 6042C letter, or an unexpected receipt of a tax transcript, or the IRS notice doesn't basically correspond to anything submitted by the filer. One of those things where it seems like, well, why we get this document? That's not good. Or flip side of that, failure to receive expected and routine correspondence from the IRS because the ID theft has changed the address to make their ID theft work. So those are sort of things your client should be aware. If they notice those, they should consider potentially contacting the IRS regarding a potential ID theft. At least go get a transcript to try to figure out what's been filed, and what things have been filed that you filed and what things have been filed that you didn't file. Finally, they mention in here they are going to start requiring additional information. We have mentioned that before, that the IRS on entity returns is going to start asking for information. This is their know your customer questions. So you'll be filing in things about who signed the return, their name and social security number, information on the tax payment history of the company, information on parent company information that may be requested. Additional information may be requested based on deductions claim that your system may ask for. And they're going to look at, do you know the tax filing history of the company? The release also, though, goes on to note that apparently there'll be some more information they start asking for. Specifically, sole proprietorships and partnerships filing K-1s will be asked to provide additional information items such as a driver's license number. This is the first time I can recall. Now, this is a combo IRS state project. It's not clear from the way this is written whether this driver's license information will go to the IRS or not, or this is simply that some states may require this. But don't be surprised if those driver's license questions we begin seeing for individual returns start expanding into entity returns. We have to start worrying about them on those areas. Next up, let's go to a court case. This is the case of the Obervold Foundation, Inc. versus Commissioner, Tax Court Memorandum Decision 2018-57, issued on April the 30th. And this is a case of an entity that applied for tax exempt status. And the IRS denied the application. Obviously, they have a right, therefore, to go to the tax court to appeal that particular ruling by the service. The foundation was established by an MD, right? And it was meant to do various things. As it was titled, as the court said in its opinion, the primary purpose would be to deliver quality management consulting services to medical providers and advance government programs through patient safety initiative. Its quality management services would include defining, identifying, analyzing, measuring, and controlling system and procedures to ensure desirable outcomes. In addition, it would also provide uplifting services for the elderly and veterans, housing for low-income individuals, and internal auditing services. The taxpayer in this case. Now, interesting aside, the founding physician here would be the sole employee, a CEO, and president. He would perform all the services provided to clients at an hourly rate of $350. They'd bill the clients. He'd receive a $217,000 salary, I should say, and be eligible for an annual payment-based bonus not to exceed $100,000. While it hadn't entered into any contracts yet, its fee structures would be market-based and dependent on the nature of the project and the expertise required to complete it. Now, the doctor here said, I think we should qualify as a tax exempt in the healthcare field, that we're a not-for-profit organization. The IRS said, we don't think so. The doctor said, well, you're just not right about this. He went to the tax court. Tax court, same problem. What's the big problem here? To be exempt under 501c3, yes, doing health services, health is one of the areas. But it is important the organization be organized and operate exclusively for the exempt purpose, and no portion of its earnings inure to the benefit of any private shareholder individual. In a lot of cases, the courts have looked at an issue saying, well, okay, does that mean a not-for-profit cannot have employees? No, obviously, we may pay people for services. That's what we do. We'll hire employees. But the courts began to think if something looks like a commercial enterprise, and especially when in a case like this, everything's going to one service provider, who, by the way, is the one that organized the entity, then we have a potential problem on the concept of private inurement. What the tax court said was, look, this is really just the doctor's consulting business. That's all it is. It's his consulting business. And like any other for-profit consulting business, this thing is not tax exempt. You're not going to be allowed to claim a tax exemption. Essentially, it would develop his business relationships, further his consulting career as a board-certified expert in patient safety and risk management, and potentially pay him annual compensation in excess of $300,000. That's from the court opinion. The benefits relating to this would inure to the doctor, its sole employee service provider, and primary source of funding. Because it'd be operating for commercial purposes and for the benefit of the doctor, it does not qualify for exemption. It's kind of obvious in this case. You would think that this is not something likely to qualify, but you see people try stuff like this from time to time, where they try to take what's basically a commercial business and say, well, not-for-profits operate in medical, which is true. Not-for-profit organizations operate in medical. But, you got to get by the smell test, and this thing just really never got by even the beginning of a smell test in order to get its exempt purpose. So, yeah, I think the tax court probably got this one right. Next up, more information regarding the Tax Cuts and Jobs Act. This is Notice 2018-41, issued on April the 28th, and it deals with a thing added in the Tax Cuts and Jobs Act. The Tax Cuts and Jobs Act added Section 6050Y, I should say. They added a reportable policy rule. What's happened now in life insurance is we've had various ways where the original holder and the insured, let's say, for whatever reason, sells the policy prior to dying. So the policy's taken out. There's an insurable interest in the person. So the policy is legitimately issued. But then, let's say many years later, this person decides, I don't want the policy anymore. And while he could cash it in for cash value, he might find that there is somebody willing to buy the policy from him or her based on, his medical condition, all those other issues. Now, up until now, the hitch is if he had cashed it in, the insurance company would have reported the cash value and reported the basis, and we would have had, report taxable event. Well, selling your policy, unless we're talking here about a viatical settlement, and under the special rules for viatical settlements, you want to check into if you have that. For those not aware of viatical settlements, is where there's offered essentially to get early benefits from the life insurance policy for a insured with a terminal condition. So that's under special rules. We're not going to really talk about that here. This is just let's say, I'm 65. I had this insurance policy. Its primary goal was, let's say, to allow me to pay for my kids' college educations. If I died during my working years, I didn't die. My kids are now all out on their own. I've essentially got now this policy that I've now figured I don't see a need for anymore. And it would probably serve me a lot better if it was cash, we might decide. So I sell the policy. Maybe my health's not great. So somebody's willing to pay me a premium that's well in excess of the cash value of the policy to have this policy in place because they believe, of course, that I'm likely to, kick the bucket, shall we say, in a time frame that would make sense for them to keep the policy alive. Well, if I do that, the IRS has never told that happened. So Congress decided that these things might not be getting reported, and so they decided to issue this new regulation. Now, under this regulation, there's going to be a report issued, and if you sell your policy, right, in essence, in this case, the acquisition of an interest in a life insurance policy, if you have no substantial family, business, or financial relationship with the insured apart from the acquirer's interest in the policy. And in this case, any person who acquires such a policy will need to file a report with the IRS that'll give the name, address, and ID number of the person of themselves, who they, the person acquiring the contract, the name, address, and ID number of the recipient of payment, the date of the sale, the name of the issuer of the policy sold, the policy number, and the amount of each payment. They also have to provide a copy of that to the person all the people they paid for the policy, as well as the insurance company, right? And, all of those issues, the information has to be provided to all of those. The issuer of the contract also will need to report. It'll send the name, address, and taxpayer ID number of the seller that transfers interest in the contract, investment in the contract, and the policy number. So with those two documents now, the IRS will know that, Joe, I was paid, let's say, $400,000 for this policy. I will now know that my basis in this policy is $320,000. IRS now has the information to compute gain. That's the theory of this. The problem, of course, that Congress said, oh, yeah, start reporting this right away. And of course, we have no, methods in place to do it. So what the IRS has announced is they're going to delay the reporting for this. So reporting will not be required until regulations are issued. So for now, you're still going to have to report the sale, and you're still going to have to report your sale and pay tax on the gain. It's still taxable. That doesn't change. Now, there is a change made to the transfer for value rules, and that's also in this provision. Remember, generally, death benefits for an insurance policy are not taxable. But if you have the transfer for value issues come in place, then those benefits become taxable if they're in excess of the basis of the contract. And basically, this goes back and takes out some of the exceptions. So if you have a case of transfer for value issues, you may want to go take a look again at what's changed in the transfer for value rules. Okay. So in this case, right, we get rid of these things. It removed it removes some special rules about, as they say, the second sentence of 101A2 does not apply. And that sentence says essentially, if such a contract, in essence, we're going to have an exception that says transfer value does not apply. If the contract or interest therein has a basis for determining gain or loss in the hand of the transferee, determined in whole or part by reference to the basis of such contract or interest in the transfer, or if such transfer is to the insured, a partner of the insured, or a partnership in which the insured is a partner, or a corporation in which the insured is a shareholder or officer. If you have any of those transfers and the party meets the requirements of this rule, remember, for a reportable transfer, it's somebody under the code who essentially has no substantial business, family, or financial relationship with the insured. The concern there, I'm sure, is that people were setting up these temporary partnerships that really there was nothing going on, but we create a partnership so we could kind of work around the transfer for value rules by having a transfer to a partner. Now we're saying, nope, you got to have a substantial business relationship. So if you had somebody that sold their contract or is planning to sell the contract, they said, oh, yeah, we got this great deal. We're going to set up this partnership and solve the problem. It doesn't really solve the problem anymore, right? Be careful there with any structure like that. Again, if they have a substantial, if you have an operating business, operating partnership, this doesn't affect you because it's not a reportable sale. But if that's not, and you have what's a paper partnership that was created merely to work around the transfer for value rules, Congress kind of shutting that down. Next up, we're going to talk now about when can you rely on what your tax professional tells you. This is the case of Keenan versus Commissioner. This is a case tax court memorandum decision 2018-60. It was issued on May the 3rd of this year. And this is a Benistar 419 case. And this particular taxpayer had entered into an agreement. Benistar was selling these 419 plans. And like a lot of these welfare benefit plans, the whole point of this was to buy lots of life insurance and to claim it all as a deduction on the business return. So wipe out the business income, have this life insurance bought tax-free. And then there was always this way of rolling it out the back end so that it didn't become taxable to the individual, to the owner, when it came back out. Now, these plans have not worked terribly well. In fact, an attorney I know here in the Phoenix area quipped a number of years ago that, clients come in with these things, and he said, and I'll offer to look at them, the programs. But he says, but he tells the client up front, I have looked at all kinds of these now. He said, and I have yet to find one that actually works, that would deliver the benefits the way they're being presented to you. In essence, for a 419 plan, they exist, they're useful, they can work, but they don't work to allow you to do this type of shifting. So you're just buying life insurance. And we all know that's what you're really doing. And, and avoid any risk of that not coming to you, avoid any risk of you not getting your policy, avoid any risk of you having to actually pay for somebody else anything of significance. Yeah, that doesn't work. Well, this is another one of such arrangements. In this particular case, the client's CPA had come up to him and told him about this program, this thing he had heard, this Benistar 419A, this 419 plan. So we had this employee benefit plan. It was used to purchase tons of life insurance. Now, he took him to an attorney. The attorney in question was also a life insurance agent. And one of the agreements came down and said that it was that they made it clear that the attorney would be fully compensated for this as the agent getting the commission on the policy, and he would not charge for any tax planning work. And then the CPA also was there. So the CPA told the client, here's a wonderful deal. And the client went, he talked with this attorney, who's a life insurance agent. The attorney says, oh, yeah, it's a wonderful deal. And he signs up and goes to the program. For the year in question, he claimed a deduction of $3,060,000 on his return, which was kind of interesting because they looked, and the only payments they found into this plan was $1 million paid in 2003 and $1,460,000 in 2004. Nobody could explain how $3,060,000 somehow magically became the deduction on the return. Even better, when the CPA prepared the return, the CPA did not put the $3 million on the employee benefits line on the return, but he put it into cost of sales because obviously it's a cost of sale, right? Not so right. Now, the taxpayer claimed, of course, what happened was there were a whole bunch of Benistar cases came together, and the taxpayer had agreed to be bound by the result in the Curcio case, right? And in the Curcio case, the tax court in that case, sustained by the Second Circuit, ruled that the program simply didn't work, that the tax benefits were not there. So therefore, the deductions are disallowed, and that the taxpayers owed a penalty for essentially misstating their income. There was a substantial underpayment penalty. Now, of course, now it comes back to finish up this case. He'd agreed to be bound by it. The court came in and said, well, according to this, you owe the money and you owe the penalty. The taxpayer said, no. Okay, I know I agreed to the result of the case, but okay, now I think it's unfair. I shouldn't be bound by it. The tax court originally said, sorry, you're bound. The taxpayer in this case appealed to the Ninth Circuit Court of Appeals. The Ninth Circuit Court of Appeals ruled that the taxpayer, even though they'd agreed to be bound by the prior case, if in fact it turns out that it would be essentially manifestly unfair result would occur if they were bound by this because of, for whatever reason, that they had a right to get out from under it. So the Ninth Circuit said, tax court, you can't really say, sorry, you're bound, get out of my courtroom. You have to go back and, listen to their argument about why this would be a manifestly unfair result, and then decide if, in fact, that's the case. Is it manifestly unfair? The taxpayer was not really disputing the deduction, but the taxpayer was disputing the penalty. The taxpayer claimed he relied on the CPA and the attorney/insurance agent, their advice in the program. In the Curcio case, the court had ruled that, in fact, the taxpayers did not really do any inquiry to find out if their CPA, or whoever advised them, their tax advisor, their tax professional, had any special knowledge of welfare benefit plans, had any knowledge of how they work, the law with them, and what counts and what doesn't. They also found in that case that, and the insurance agents, or like this attorney who's an agent who is being, who is putting the policies in place, that this goes back to the old neonatology case. You really can never rely on the advice from a party who can only be compensated if the deal goes through, right? That's considered to be a disqualifying. In essence, you're not allowed to rely on effectively the promoter to tell you, to say that, well, that was a reasonable attempt. To be able to get out of this penalty for having reasonable cause, a taxpayer needs to show generally that they took reasonable steps to attempt to properly compute their tax liability, and for, due to no fault of their own, that liability was not properly computed. This taxpayer had a couple of problems before we ever got started. First thing this taxpayer did, if you read the actual opinion, they quote from the transcript, and he admitted that he never, ever, ever read the tax return. His client, the taxpayer, the preparer comes in, they put the 1040 down in front of him. He just signs it. He doesn't care what's on it. He signs it. He admitted, and they said, well, what about this year when you had this big deduction? It's going to be unusual. Didn't you at least want to look at that on the return and try to understand that? Oh, no. When the return was done, he just took it, signed it, and, had it filed. Bottom line, client's never going to be able to claim reasonable reliance on your opinion, at least to get out of the penalty, if they don't check the return. Now, I want to warn you right now, because while I say that's true, that doesn't mean that when the client tries to then pursue you in state court for the penalty by claiming that, you didn't fulfill your contract with them, that the state court's not going to say, well, sorry, you should have told them about this and you didn't. And so, yeah, you get a right to check. So this can be bad news. The client gets penalized. Now the question is, can the client then in state court shift that to you? Bigger problem. So, yeah, we need to be concerned about this. So bottom line, you need to be concerned about clients who just sign the 1040 and don't worry about things. Especially, though, by the way, if you're doing something quite as flaky as this. The other problem that we ran into was that, of course, they asked the CPA about that $3,060,000 and why is it in cost of goods sold? And the CPA essentially admitted they were concerned about being audited. And they were really concerned about showing $3 million on the line for an employee benefit plan, considering that probably would flag the return, and the IRS might come in and want to take a look at how the world they get to $3 million. But even though the court said he had some weird theory about why it was okay as cost of sales, the court said no. The reason it's in cost of sales was simply to hide the return and keep it from being disclosed on the return this was being claimed. He said, so overall, first thing is, again, like the taxpayers in Curcio, there's no evidence here that you ever actually decided, did this person have any expertise in the area? So, that's kind of a problem. Number two, no real evidence you took actions to figure out what your tax really should be. You just signed off and did it. And third, it was hidden on the return. You weren't trying to disclose it. That's not what somebody who's acting in good faith would do. So because of that, they said there was no actual reasonable reliance on either the CPA or the insurance agent. And because of that, they owe the penalty. Again, key issue. You need to, for your own protection in many ways, you want clients to look at the return. The client does not get protection. This is what's key to understand. There's not really protection for taking your advice unless they actually seek and obtain your advice. Merely having you do the return does not provide them protection. But again, that doesn't mean that a jury is not going to find that way if they come against you for the fees, basically for the penalties. So be careful out there. Well, it is May. Time to get your CPE together. A time now to sign up for your state CPE Society courses online. You've got online signups. You've got your catalogs. Take a look right now. It's really nice. Set up and plan how the year is going to look. We have a lot of things planned this year. The state societies have added a bunch of courses related to the Tax Cuts and Jobs Act. Remember, this is going to be able to sit down a full day and talk with people about how this law works. It's not a bad thing. Like I've noted, I'm going to be late this month. I'm going to be in Phoenix doing a session on May the 30th, as I recall my dates. And then I'll be in Albuquerque the next day on the 31st. We'll be talking about the Section 199 Cap A deduction, qualified business income. What is it? How does it work? Plus the other impacts on small businesses coming from the Tax Cuts and Jobs Act. Things like that are going to be in your state-sided catalog. Be sure you go check it. This has been the current federal tax developments for the week of May the 7th, 2018, brought to you by Kaplan Professional Education. You can catch our updates every week online at currentfederaltaxdevelopments.com, so we'll write things up as they happen. You can send any questions or comments. I'm Ed Zollers at currentfederaltaxdevelopments.com. Email me there. You want to follow me on Twitter, you can find me at Ed Zollers on Twitter. And also, as I note, I follow discussions on the subreddit, the Tax Pros subreddit on Reddit. That's at reddit.com/r/taxpros. Also, we'll tend to check in from time to time on the Tax Talk discussion group that's run by California Society of CPAs. Also, we'll check in on Arizona's discussion group from time to time. So you may see me in those places. Otherwise, have fun this week. Hopefully you're starting to now slog through and, get a little bit of relief, getting rid of those extensions and knowing that other people who went on extension, you'll hear from them October 1st, all that neat group. So have fun, take care, and we'll see you back here next week for more on current federal tax developments.